All right. Now, those that understand the lasers, the green or red lines coming out of our footprint, follow me. If indeed you're looking for the market to go up, you'd like to get more shorts than longs because shorts are buyers to cover a short position, right? And you need buyers to come into the market to rally the price of anything. Well, that would be indicative of a red line. So as soon as you see, and just watch this area right in here, our red line come in, boom, you generally get it when it rallies. When would you want it to go, you know, predict it's going to go down or stop going up? When we see a green line. We see a green line, it rotates, and does go down, albeit a little bit, but it did stop the rally. When would you anticipate it go back up? I'll give you a clue, a red line. We go red, green, red, and it does go back up. So when you talk about real-time analysis, you get green, goes back down. You're trying to get stuff that gives you what? Either a really good ability to make a prediction with probability. And because that probability is higher, that's where confidence comes from. And you're not going to get consistent until you're confident. And a lot of people want to get uh, confident and then they'll get consistent. In my opinion, it's the opposite. You get confident before you're consistent. That's where consistency comes from, confidence. So the point is, that's really important when you're maybe not the only thing to predict upside and downside, but the notion of understanding why it would make sense that it would create the higher probability to start to go down when you've seen green, to start to go up when you've seen red, because you understand it's showing us the not only shorter time frame positions of traders, but comparing it to other positions. Two positions you could have, either long or short. When you compare them to each other, you could start to find value like you do with anything else. You have to compare and contrast to help find value. Like we use that technique in everything we buy and sell. To assign value to it, we generally always compare and contrast, period. Nobody debates that. So in this case, what are we comparing? Longs versus shorts. And when you get more longs than shorts, then it should make sense that you get more, I'll abbreviate, sellers than buyers, more sellers. How do you get more sellers? Because you get more longs. More longs. Let me take you right back to the beginning. If longs indeed equal sellers, meaning after you're long, you know this, put on a long position, you probably automatically put sell orders in the book. Sell stop below and a limit sell above for your profit target. So I don't have to convince anybody listening to this, even if you're listening to this listening to me for the very first time. You don't have to be persuaded that after you long, you become a seller to cover that long position. So if you're convinced that indeed longs are sellers, okay, if you get more longs because you're comparing them longs versus shorts, all right, that's the matchup. And if you have more longs than shorts, then you have more longs. Well, if longs equal sellers, then more longs equal what? More sellers. What do you need for the price of anything to go down? More sellers. And not necessarily people who sell it, but more importantly, people who want to sell it. There is a difference. And it's helpful to know that people are lining up to sell it. And when they try, they can't get filled. When they stick their hand out to shake someone else, there's no hand to shake. So they have to go lower and lower and lower in order to find, value to fill their order. In this case, a sell order. More sellers means a higher probability for the price of whatever you're trying to predict to go down. And so we compare. How do you know there are more sellers? Because we take it back to comparing positions. comparing positions. Most of the stuff that's out there, that's been out there with respect to trading, especially trading futures, and all the features and all the tools and all the drop down windows from all the charts and all the software that you have to download and re-download and call support and figure out what this is, and then go down rabbit hole after rabbit hole to figure out what's important and why moving averages are great and stochastics are even better and Fibonacci was smart and all this other stuff. And you always generally skip over the most important information of what are we trying to figure out here? Buyers and sellers, sure, but other people's positions. You're trying to find other people's positions. If you knew everybody's position, you could trade with your feet, put the mouse on the floor. We can't get that. Just like we can't get an economic number 5 seconds before it prints, okay? Or know that there's 1,000 lot sell order coming a half a second before it hits. Well, we can't get that. We would know what to do with it if we could get either one of those, right? We can't. But what we can do is get ahead of being able to take MBO data and filter it in a way we know how, because understanding price discovery and understanding what influences the price of anything, and then get a sample size of other people's positions and use that as a way to find value, which is what's needed to create the prediction of the next move or the next tick, and so on and so forth. And therein lies an edge. You never should stop looking for an edge. And like I always say, there's always a better way to see the same thing. But most people don't know what the same thing is. They know what are we looking for? They don't know what the tool does or what it looks like. They're trying to learn to be a carpenter and they don't know what a hammer does, what it looks like, or it exists. And yet it's a very important tool of being a carpenter. So if you don't know that the tool exists, you're going to have a hell of a time identifying it and then hell of a time using it. But the same thing, when I say a better way to see the same thing is other people's positions, all right, which is essentially order flow. When you people get turned on to order flow, I mean, that's what you're trying to do is understand orders with respect to them covering or entering positions that they're using that order for. All right. That's the same. That's one of the concepts that should never go away in trying to predict price and trading or whatever it is you're trying to predict with respect with price attached to it. If it has price affiliated with it, well then people who want to and buy and sell it are going to be important, and that order flow and that and those positions with it within that product are important to understand. The other thing, from a concept standpoint, is a thing called market correlations. You know, we're in an environment where other markets are influencing the market you trade. The higher the volatility, the more correlations exist and the better that they work. And therefore, if there is something where there's a cause and effect in the product that you're trading and you're not watching that, then you're missing a very important piece to the puzzle. And the puzzle is, where's price going? And when is price going? So if you're missing important pieces, you're going to have a hell of a time finishing the puzzle. You know, it's going to take you longer. It's going to be incomplete. So market correlations, market relationships, comparing something to something else to find value is what we've used since they invented price. Don't ignore it, embrace it. And most people ignore it once they open up a trading account. Maybe it's not their fault because you don't know what you don't know. And then the other thing is understanding how people are putting, placing, opening, closing positions and why that's important, because emotion comes from being up in a trade, down in a trade, too many in a trade.